Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The false break higher back in August over the top of the diamond pattern, which I highlighted in dark blue, formed over November 2021 to July 2022, eventually started a move that led to where we are today. The pipe top formed on the 9th and the 12th of September were the direct triggers for the start lower. The actual pattern, the lopsided diamond, is huge. I had given a primary target for this in the 166 3/4 area, whilst the secondary harder to achieve target X1 would be in the 142 area. The primary target was achieved in early November, and the harder to reach secondary target X1 is at the bottom of my daily chart at the moment. I said at the time when I indicated these targets many months ago, and I quote, "Needless to say, given the size of the lopsided diamond pattern, these proposed targets below, assuming the break lower holds, are some longer term targets," end of quote. I also continued, and again I quote, "There is one other fly in the ointment. Perhaps, just perhaps, the lopsided diamond pattern is becoming a big bear channel. If that is to be the case, then the first area to look at below would be the lower bear channel line of such a pattern, currently at 170.5, end of quote. The extension of this bear channel you can see highlighted in bright green, and the lower bear channel line has played a part in recent actions. This lower bear channel line was joined in part by the 50% Fibonacci line, the May 2019 to February 2022 move at 174, and I will look at this again in more detail shortly. However, between the extended lower bear channel, the neckline, and finally the 2017 high at 159.30, and the combination of lesser Fibonacci lines at 153.60 plus the May and June 2021 congestion at 153.30, well, prices seem finally to stop their headlong fall 3 weeks ago. The reactionary move back up was triggered by a combined key reversal up and bullish engulfing pattern 3 Mondays ago. But as I said 3 weeks ago, when referring to recent moves lower, and I quote, "The moves lower are not uniform or smooth. It may just be a case of 2 or 3 steps down, followed by 1 step up. We shall see," end of quote. The latest peak was last week when we had a combined key reversal down and bearish engulfing pattern. Last Thursday that peaked at, yes, the earlier mentioned 50% Fibonacci line at 174 even. Indeed, it was ever so a little higher that between the 50% Fibonacci line and nearby August 2021 low at 174.5. Friday saw a subsequent move lower, but today has not extended that move. I am mindful that the lower bear channel line and the neckline crossover on the 20th of December, which is where I imagine their greatest capping potency would be if prices remain below both. So I'll be interested to see what the pattern market develops between now and then. Now, upon reflection, and it took me a little while to come back to this, upon reflection and at a second look, I am wondering if this all may be turning into a descending scallop pattern, especially after looking at London coffee, where it seems a more reasonable idea. London coffee. There were in the recent past 2 key relevant features here in relation to the start of this fall in this market. The first was early on. It was the early August until late September type of head and shoulders pattern. The second feature was the late August to mid-October falling wedge pattern, highlighted on my daily chart in bright red. This gave added depth to the fall and saw prices drop 3 weeks ago all the way down to the lower time, currently at 1748, of the late December 2021 to mid-July 2022 bearish Andrews pitchfork, which I have conveniently highlighted in dark blue. Since then we have seen the market curl upwards, though as it has tried to do so, it's shown increasing indecisive patterns, especially over the 2018 high at 1845 and under the congestion at 1897. 4 weeks ago, I indicated we might see this happen when I said, and I quote, "Look at the 50% for the Fibonacci line at 1812 and the nearby lower time as the end of the current move lower, leading to some possible consolidation before a possible attempt up towards the congestion overhead starting at 1945. End of quote. I did go on to lay out other possible scenarios involving similar patterns, but you get the gist of what I meant. Thus we come to today, and I would like to put forward a new suggestion on what may be happening. You see, looking here, and also a little at the New York contract, I have a suspicion that the action since mid-October may be sliding towards a possible descending scallop pattern, sometimes called a backwards letter J pattern. It is still early, but especially here in the London contract, this has merit, and I will expand upon this idea further should it develop. Finally, I would like to finish by reprising my final point from 3 weeks ago, and I quote, I would like to point out two potentially impactful factors that are rapidly approaching the market from below. They are highlighted in pink, and they are the January 2021 to date uptrend, currently at 1730, and the October 2020 to date uptrend, currently at 1721. By the end of December, they will mix in with the congestion zone 1740 to 1746 that contains the August 2021 low at 1743, which may make for an interesting time as the lower time will be down there as well. It's the end of the quote and this part of the commentary. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.